In this video, I'm going to show you some of the stock investing strategies used by elite investment managers that you can also use as a high net worth individual. Most financial advisors claim that index fund investing and analysis of companies' financials are the keys to successful investing. Now, I've analysed over 100 of the top investment managers, and the absolute best, the ones that return over 20% annual returns consistently, all have the same approach of how to actually achieve outperformance. And it's usually never because they're just good at financial analysis or picking index funds. They all have additional strategies that they use on top of these to increase their odds of success, of which I will share a few of them in this video. So before I dive right in, I should quickly introduce myself. My name is Daniel O'Loughlin, and I have over a decade of experience in the investment world. I was an investment analyst at S&P Global. I hold a master's in finance. I'm a chartered alternative investment analyst, and I've also published papers on predicting asset prices that made a significant impact in the field of investments and behavioral finance. But most importantly, I spent all these years studying markets and developing the tools to consistently outperform them, which ultimately allowed me to quit my job to pursue managing my own personal wealth full-time 4 years ago. So after this video, you'll know some additional strategies on how to choose stocks that outperform. So let's dive in. Firstly, positive price momentum is one of the most important factors in safely finding stocks with the potential for massive growth. Have you ever heard the term past performance is not indicative of future returns? This must be one of the biggest lies in finance ever told. Assets trending upwards in price has been proven to increase further more often than not in the medium and long term. It's a phenomenon that's been heavily studied by academia and has been proved through many scientific papers, by data, and also through my own personal experience of using this to help outperform. So let me show you an example of how to actually use this. Now first, we give a caveat. Just because there is positive price momentum, it doesn't mean that it's a guarantee or that the stock will continue going up. It's just an indicator that you can use to stack upon other forms of analysis to help you form your base case on whether your investment is a good one or not. So let me show you how to use it. For our first example, we'll use Nvidia. You want to look at the company's price chart, and both line charts and candle charts will more or less give you the information that we're looking for. So what we are looking for when we're looking at these price charts is, first of all, you want a chart with a long-term price history. An IPO isn't going to be much use to you because there's only going to be a few days or even worse, hours of price chart history. It's not very useful. So we want a long-term chart with lots of price history. So here, looking at the Nvidia chart, it has over 15 years of upward price momentum. And if I'd found the stock anywhere between 2014 and 2016, I would have been analyzing this company heavily. So what we can see through this chart is, first of all, we can see that there's higher lows appearing as we continue through time on the chart. And so what you can see is somewhat of a reversion to this level of support. Now, ideally, you want to see a few months, if not years, of the support developing. And you can see in the period of between 2014 and 2016, we've had enough history to see, okay, this is a relatively safe area to get into, considering it's a tech stock. And if the price falls below this support level, well, then we can easily sell the asset without incurring much of a loss, while hanging on for the possibility of massive asymmetric returns to the upside. Now, when the higher lows also get higher highs and the price chart starts to go up like this, it's often the start of a parabolic movement. Now we'll look at a second example, which is Air France KLM. It's important to note that this idea, the momentum factor, is also true for companies that are trending downwards. So here's an example of a company I would never invest in, simply because it doesn't meet my prerequisite for having positive price momentum. So as you can see, there is no period in the entire history of this price chart where you could say that you got in at a good price, because ultimately you're going to be down money in the long term regardless of what price you got in at. Now, Air France and KLM are great airlines, and the company has had great years financially and has oftentimes had good news, but that's just not simply enough. So checking the chart of a company first is great because it can save you so much time from analysing a company that's struggling to do well. So remember, make sure that there is an ever-increasing price floor. Even companies that are going sideways for many years continue to do so. Now, here's a second investment strategy. Technology is the best industry to invest in for wealth accumulation. Now, you might be thinking, wait, is that not risky? Well, what if I asked you about investing in railroads or steel manufacturing or automobiles? You would probably say that these are more stable, less risky industries. Well, all of these industries were once considered technology, and they created huge amounts of wealth for their investors at that time. These companies often provided the same, if not more, financial returns compared to the tech companies of today. Technology is simply a catch-all term to describe any industry that's increasing productivity. Today, that's AI, but in the past it was oil, steel, even banking. When investing specifically for wealth accumulation, a lot of your portfolio should be geared towards technology plays. You're trying to invest in the things that will push human innovation the furthest the fastest. This factor has been a consistent trend for over 150 years, and I think it's more prudent to take the data of 150 years over the advice of nearly every financial advisor who says technology stocks are too risky because of just the books that he reads that tell him so, without looking into it himself. Now, there is a caveat to this. First of all, technology companies are more volatile. Now, it doesn't necessarily mean that that's a bad thing. Here's the truth about volatility when you choose good quality assets. The good quality assets that are more volatile are asymmetrically skewed to the upside, meaning yes, the drawdowns are larger on average compared to other investments, but the price appreciation is much higher. Look at Microsoft, look at Amazon. Financial advisors will often say that these companies are risky and that maybe you should avoid them. Yet these companies have impressive financials, positive supply-demand dynamics, competitive advantage, the best management, and an increasing price floor. The impressive returns that come from these companies are going to the talented investment managers who actually know how to invest for outperformance, while the average financial advisor is recommending companies like Air France because they think that they're undervalued. So there are two important things you need to note if you are including technology companies in your portfolio. First of all, you need to ensure that you won't need to sell these for any reason in the short to mid-term. These are volatile assets. You still have to buy low and sell high. And if you end up buying high, the drawdown could be quite large in the short to medium term. And so especially for these kind of investments, you want to be buying low and holding long term. And then secondly, you want to make sure that these investments are strong companies in their own right. Many tech companies are genuinely too risky to invest in. Therefore, you need to stack up all the information you can get, not just the financials, to make sure that the company in itself is a good investment. Now, the next points in this video will be very useful factors to use when you're trying to analyze a stock. And by the way, if finding these high growth opportunities is what you're interested in, but you don't have the time to look into it all, you might benefit from access to our private wealth desk. If you'd like more information on how we can save you more time, grow your wealth, while staying in control of it all, click the link in the description or visit senecaprivate.com/apply. Now, the next factor we're going to talk about is make sure to choose a company with great management. Top performing companies have exceptional management and people in general. An important observation I've made from looking at hundreds of companies over the last few years is that many of the best performing stocks had elite management teams and generally had high employee satisfaction too. An amazing book on some of the factors that are inherent to companies that outperform while others stay average is called Good to Great by Jim Collins. Now, in this book, the author mentions a few factors that contribute to outperforming companies, but I particularly found his concept of level 5 leaders really interesting. Collins describes level 5 leadership as a leadership style that combines two somewhat contradictory traits. The first is personal humility. These level 5 leaders don't seek personal fame, credit, or recognition. They're humble and more concerned with the company's success rather than their own ego, and they often deflect praise to their own team while at the same time taking responsibility for their failures. And then the second point is a fierce professional will. So despite their humility, these leaders are incredibly determined and driven to make their company succeed. They're willing to make tough and sometimes painful decisions to ensure long-term success. And instead of chasing short-term gains, they prioritize sustainable growth and operational efficiency. Let's take Abbott Laboratories as an example. Between 1974 and 1999, Abbott's stock outperformed the market by 4.5 times and also beat major competitors such as Merck and Pfizer. And what's interesting to note here is Abbott's management team. They exemplified many of these level 5 leadership traits. So the company's transition was largely driven by a disciplined, low-profile management team that focused on sustained performance rather than flashy corporate moves. Abbott's leaders were not celebrity CEOs like Jack Welch from GE or Steve Jobs from Apple. Instead, they were quietly, yet aggressively, focused on long-term profitability and consistent strategic execution, rather than making drastic and attention-seeking moves. They also didn't rely on one single genius CEO. They built a strong management pipeline, ensuring that the company wouldn't collapse even if one of the leaders left. You can also use the contrast of this idea to know what companies to avoid. Non-level 5 leadership companies often make big, risky bets, or they constantly shift strategies, leading to short-term gains, but long-term instability. These are the kind of companies that many financial advisors will recommend because they get sucked into the narrative of some companies' turnaround strategies, or because after a restructuring, their financials look so much better. Now, the stock might go up and down like a yo-yo, and it might even turn a little profit in the long run, but then the opportunity cost for missing truly good companies is so much bigger. So here are some ideas for identifying these strong leadership companies. Firstly, employee satisfaction and retention. If employees are leaving in droves, that's a red flag. Glassdoor reviews can be an interesting tool. Employee turnover and satisfaction is a metric that counts. Secondly, you can look at the CEO track record. Has the CEO actually built something before, or are they just a flashy name? And then thirdly, you want to look at consistency over hype. Look at the long-term decision making and don't just look at the quarter-to-quarter performance. Great businesses are led by great leaders. Find them and you'll find winning stocks. Now the next point is more of a financial metric that's really worth looking at that is often not used or overlooked. This is where checking on a company's return on invested capital comes in. Sustainable high-growth companies are often accompanied by a high ROIC. This metric tells us how much return a company makes when it invests in itself. So think of it this way. If a company is a machine, ROIC measures how efficiently it turns every dollar of investment into profit. If a business is pouring money into growth but barely even makes a return, it's not really investing, it's just burning cash. Now you might be wondering, how high should ROIC be ideally? Now not every company needs a high ROIC, but I have a general rule. If a company's ROIC is higher than 10%, I'm interested. Now if it's above 15, even better, and if it's above 20%, now that's serious compounding power. The point is, high growth companies with low ROIC are a little risky. They might grow their revenue, but if they're investing it poorly, that growth could be unsustainable. So overall, high ROIC companies, they don't just grow, they grow efficiently. They compound wealth, reinvest smartly, and scale without consistently needing outside capital. Take companies like Microsoft or Google. They're all known for their strong ROIC, their steady expansion, and long-term dominance. They don't just chase growth for growth's sake. They invest in ways that generates outsized returns. Now the next point is so easy to implement, yet it adds so much upside to a portfolio. You want your money going to where the most popular place will be for future investment, and growing industries generally get the largest share of investment. If you find a great company that has strong metrics, imagine how much further it can go when you can ride off the back of the inflows of capital coming into that industry from hedge funds and pension funds, for example. So what are growing industries right now? Well, there's AI, cloud computing, and machine learning. I'm going to throw in an additional strategy here into this concept by way of an example. Oftentimes it can be really difficult to know which company is actually going to outperform. I've observed that even when you pick companies that appear to be the strongest, the ones that are most promising, tick all the boxes, still sometimes isn't the one that outperforms the most. So when you're making a bet on an overall industry rather than a specific company, it might make more sense to split your allocation across 2 to 3 different companies. This reduces the impact that you would face from one company doing bad in that basket. In 2020, for example, I was seeing positive signs in the solar industry and I wanted to get exposure. So I ended up with a short list of about 10 companies. I split this solar play across 3 different companies, choosing the best of the 10 that I was looking at. So in March 2020, I published my annual investment letter, which I only distribute to friends, family, and now clients of Seneca Private. And in this investment letter, I highlighted 3 companies, Encavis, SolarEdge Technologies, and Enphase Energy, as my top picks for taking advantage of this opportunity that I saw in the solar space. And the result after 1 year of making these investments was that Encavis returned 60%, SolarEdge 250%, and Enphase Energy with a huge 530% return. So yes, I missed out on the opportunity to make the entire 530% return, but I also avoided only making the 60% return from Encavis. This strategy gives the benefit of not being stuck with the underperformer while still getting the majority of the upside from a growing industry. And although 60% returns is by no means underperformance, sometimes this grouping strategy can save you from the investments that sometimes happen to turn negative. Now, another important factor is competitive advantage. Companies with some kind of barrier to entry or competitive advantage tend to maintain high growth levels. S&P Global Inc. is a great example of this. They have a 40% market share of the credit rating industry. The whole industry is essentially a triopoly between S&P, Moody's, and Fitch. Now here's the barrier to entry, or the moat that they have. Most investment banks demand that their clients get a rating from at least 1, if not 2, of these 3 companies before they provide any debt facilities. Now with a competitive advantage like this, it's nearly impossible for anyone else to compete or take market share, and it shows in the growth of the company's stock price over the last few years. So in summary, you want to stack as many of these principles as you can. The more positive factors that a company has inherent to it, the better potential it has to be an outperformer. So if you're a high net worth individual and you want someone to help you with this is something that we do at Seneca Private for our clients. So if you'd like to use my track record and ability for finding outperforming assets, click the link in the description or visit senecaprivate.com/apply, and I'll see you in the next video.